Okay, for real this time. Good morning, everyone. Everything is working. Everything is great. I don't know why I was worried that it wasn't, but now it's fine. Good morning. Happy Thursday. Oh, man, as you guys jump in, let me know that you're here. Say hey. Let me know where you're joining us from. I have everything open. Let's see. So I think we should be good. I'd like to delete that. There we go. I don't know. Anyway, let me know you're here. Say hey. All the things. Oops. All right. Good morning. Oh, from Fort Lauderdale. How is the weather down there? Here, I'm in Colorado, for those of you that don't know. It's been hot, like in the 90s, but overcast, but not so much cloud overcast as smoke overcast. We aren't on fire anymore, but all the smoke from all the other fires in other states is just like coming over here. So yeah, so that's that. What else? What else? As always, guys, we're just giving everyone, it's only 65 here right now. That seems wrong, but I'll take it. Maybe I'll go for a walk after this. As always, we're going to give everyone just a few minutes to jump in so that everybody can join. Remember, you guys, these are Q&A sessions first and foremost. So go ahead, if you have questions, tax, accounting, bookkeeping maybe, start putting them in the chat, wherever it is on your screen. Remember that if you're watching this on Facebook, there is a link at the top that says we're going live. If you want me to see who you are when you ask your questions, click that link so it will tell me who you are and not just Facebook user. But I do see Mark is here because I also have Facebook open. So good morning, Mark. So as we are waiting for people to jump in, say hey. I will kind of go over some of the questions I left hanging last week. Hey, Jackie. Good to see you. So yeah, I'll start there. But again, put your questions in the chat. That is what we're here for on Thursdays at 9:30 Mountain Central Time, Mountain Standard Time, is to answer whatever questions y'all have on your plates. All right, so a few things that we kind of touched on last week, but that I wanted to come back with a little more information this week. So first, I want to talk about the advanced child tax credit payments. All right, we kind of touched on it last week. So what we talked about, so you guys know, starting in July, under the most recent COVID Relief Act, do I remember what it's called? No. I stopped trying to keep them all straight. Under the most recent one, they said, okay, first of all, so there's two parts to this, you guys. First of all, they're like, okay, we are going to increase the annual child tax credit. All right, usually it's, let me see what it usually is. I don't know, but yes, increase from $2,000, so it's usually $2,000 per child. All right, and they're like, in 2021, under this Relief Act, we are going to make it $3,600 for any children under age 5 in the year 2021, or $3,000 for children ages 6 through 17. That's their age by December 31st of this year. All right, and so that's the first part. So the first part is the credit is more this year. The second part is that they said, okay, we're also not going to make you wait until you file your tax return to get this whole credit. You can actually receive up to 50% of it in the tax year. And how we're going to do that is we're going to split whatever 50% of your 2019 or 2020, we're going to base it off your 2019, 2020 tax return, whichever one they have most recently processed. They're going to say, okay, you did qualify for it in those years, so we're going to assume you're going to qualify for it in 2021. Okay, you qualified for the full amount. Let's assume you're going to qualify for the full amount in 2021. They're going to say, okay, they're going to calculate what 50% of that credit they anticipate you qualifying for this year is, and then they're going to divide that number by 6, and they're going to pay you in 6 monthly payments, July of 2021 through December of 2021. So those payments started back in July. We're about to cash out, or we're about to start receiving our September payments here soon. You had the chance to opt out. This is something you automatically qualified for if your 2019 or 2020 tax return said, yes, you qualify for this. Okay. The IRS is not making adjustments if you're not going to qualify for it in 2021. And what I mean by that, there are certain instances where you may have qualified for this tax credit in whatever year the IRS is looking at, but you're not going to qualify for it in 2021. Examples are maybe you had a kid who was 17 and now they're going to age out of qualifying for that credit. Maybe you alternate claiming your kids with your ex-spouse and they used a return where you qualified or you took your dependents, and in 2021 you're not going to take that dependent. Another one is your income. All right, there is an income phase out on your AGI, your adjusted gross income. And if you make more in 2021, so let's say in whatever year they used, they said, yes, you qualified, but now you make too much. You're not going to qualify for it this year, okay? So if for some reason you aren't going to qualify for this tax credit in 2021, or you don't think you're going to, you probably want to consider opting out of the remaining September, October, November, December payments. The reason being that unlike the stimulus payment, where they straight said, if you get a stimulus payment that you didn't qualify for, as long as you're not dead, you're going to keep it. We're not going to make you pay it back. This credit is not like that. They will make you pay it back if you receive it and you don't qualify for it. So this could, hopefully, if this happens, it just minimizes it, or it just decreases your refund when you do file your tax return. But if you're usually on that threshold, like maybe you usually only get $500 or $1,000 back, and it's because you have this substantial credit, and this year you don't qualify for that credit, you're going to end up owing that money back. You're going to end up owing money when you file your tax return. So definitely something you want to look into if you think you aren't going to qualify for this child tax credit in 2021, even though you did in prior years. So let's see. It says Facebook user, but we know it's Mark because I have, like I said, I have Facebook open. So Mark says, if your kids did office filing for summer jobs in the business with earned W-2 paychecks at reasonable minimum wage, can you have them open a Roth with their earnings? I love this. My answer is yes. In fact, a lot of my clients, they don't even give their kids the money they earn when they work in the office. They put it straight to a Roth IRA, or they do half. They say, okay, you can have, this much money to go have your spending money. The rest we're going to put into a Roth IRA. So let's back up a second. For those of you that are like, wait, employing your kids, what is that? What are you talking about? When you have your own business, right, you can employ anybody, your kids, your parent, you can employ anybody you want and pay them a reasonable salary for doing the work within your business. So for most of our clients, when we talk about employing your kids, typically we're talking about kids that are, minimum of 8, 9, 10, 11, years old, that can come in and do things around your office. Mark says, do office filing. That's a common one. It can be cleaning the office. I have a landscape client, and their kids come with them. They pick up the dog poop, they mow the lawn, they do some things while the parents do the more tedious things, whatever it is. Okay. Yes, you can employ your children in your office. You want to make sure though, guys, that you are paying them a reasonable salary. Like Mark says, reasonable, it can be minimum wage. I mean, it can be more than minimum wage, but you can't be paying them, $150 an hour to do office filing. It has to be something you would pay Joe Schmo off the street to do. When you're employing your kids, we also recommend that you're very tedious about record keeping, meaning you're having them clock in and out, or you're having them, log what they did during the day, just in case the IRS does come back and gets a little, wants to dig into your finances or into your tax filings. You have the proof there to be like, yeah, this isn't fake. My kids really are working in my business and doing stuff in my business. This is a tax benefit, you guys, for numerous reasons. So when your business employs your kids, okay, it is a tax deduction to your business, just like any other W-2 employee that you employ. All right, but you're having them earn that extra spending money or their movie money or their lunch, whatever it is, so that instead of giving it to them, you get home and every week you give them an allowance, and that's out of your post-tax dollars, you're now using pre-tax dollars to pay, or tax-free dollars to give your kids their spending money. You're teaching them how to, earn their way in life. It has so many benefits. And this spin, and Jackie says it too, Jackie says, I love putting my son's earnings for scanning and filing towards his Roth. So there's no minimum age requirement for a Roth. Let's talk about a Roth a little bit. This is a great tool, you guys, for whether it's employing your kids or yourself, all right? So we talk a lot of tax planning, right? And much tax planning ends up being tax deferral. What I mean by this is, what it does is you're not paying tax today, but you are going to pay tax when you retire. An example of this is your 401k. Right? When you contribute to your 401k through your employer, through your business, whatever it is, you are not getting taxed on those dollars today. All right. So if I put $10,000 into my 401k this year, it is tax-free money to me this year. Now, however many years down the road, when I take that money at retirement, okay, when I take that money out, I'm going to be taxed at that point. All right, on both the principal I put in and the interest it earned while it sat there. So everything is taxed in the future. With a Roth IRA, you guys, this is actually one of the few tools where you can actually avoid tax altogether, and I'll tell you how. So when you contribute to a Roth, you're putting in post-tax dollars, meaning there's no tax benefit today to contributing to a Roth IRA. However, when you take it out 5, 10, 20, 50 years down the road, there's no tax. And this tax avoidance or tax avoidance really is what you're doing, comes in that all the interest that it's made in the time that it sat there is tax-free. So let's use numbers. I contribute $5,000 to my Roth IRA this year, no tax benefit. I just contribute it with post-tax dollars, no tax consequences. All right. 50 years down the road, my $5,000 is now worth $10,000. All right. I get to take that $10,000 out with no tax consequences at all, meaning I've earned $5,000 at that point in tax-free interest. All right. So Roths are a great, legit tax avoidance tool out there, not tax deferment, tax, like, what is the word? Elimination. Okay. And Roths are really good. A lot of our clients that I've noticed, and I took a class one time with this, and I never thought about this, but I joined, or I was a guest speaker in this financial wellness group, and they, in that group, practiced and preached of putting your emergency funds into a Roth IRA. And at first I was like, wait, what? You want to be able to get those funds, right? But you guys, with a Roth IRA, as long as your Roth account has been established for 5 years, you are allowed to take the principal out with no tax penalty or anything, okay? The interest it's accrued, you either need to leave or you will pay an early distribution penalty on taking the interest out. But the principal, the money that you put in post-tax today, right, that $5,000 I put in 2021, if I all of a sudden next year need to take it out, I can do that with no tax consequences and no penalties. All right, but I can also, if I am able to leave it in my Roth IRA and let it grow, then it's making that tax-free interest as it lives there. So Roths are great, and they're great for kids because down the road, you can take out the Roth and use it. You can take out that principal if you want, and use it for college, or use it to buy a house. You know, they do not have to wait until they're 62 and a half to take those Roth contributions back out. So Roths are a great savings tool for everybody, but specifically you're working in the business children. Oh, okay, let me take a breath. Let me take a drink. All right, I don't see anything. They're doing construction. It has to be downstairs because I'm on the top floor. and every few minutes there's just this super loud bang, and it's scary. I don't know if can you guys hear that? It scares the crap out of me, and it's like right under my feet. So like my feet jolt, and I'm just like, deep breath. So if I jump, that's why. All right, so I had a few other, you did hear it, yeah, and my mic's also really good. There was one day I was on my mic, and I could hear Lindsay talking to 2 doors down. I was like, whoa, this mic is fantastic. All right, so Mark, again, says, actively planning to convert regular IRAs to Roth in increments, realizing incurs tax each conversion amount, but it gets the government out of the picture later as they think taxes have to go up in the future. Any caveats from a CPA's perspective? So I think what Mark is saying is that he has money in his traditional IRA. All right, so let's use $100,000. He has $100,000 in his IRA, in his traditional IRA. All right, you guys are allowed to do conversions from a traditional IRA to a Roth IRA. All right, what happens though when you convert is it is taxable income to you in that year. Okay, there's no penalties because you're not taking the money out, so there's none of that. I'm so sorry, you guys. There's none of that 10% early withdrawal penalty because you're moving it from retirement to retirement, but you will be taxed on it. So what Mark's saying is like, if I'm like, yes, I want all of my traditional IRAs to go to a Roth, and I decide this year I'm going to do it. I'm going to move all $100,000 over. All right, well, that $100,000 is taxable income. And let's say I have no other income. All right, no, let's be realistic. Let's say I have $100,000 in W-2 wages too. So we're making this simple, but so now I have $100,000 in W-2 wages, earned income, and I have $100,000 in rolled over traditional to IRA. Okay, so now I have $200,000 in taxable income. Well, $200,000 is a higher tax bracket. I'm going to pay more because I have more income. Okay, whereas if you break it up, so let's say I still have my $100,000 in W-2 income, but let's say this year I only move $20,000 to my Roth IRA. Okay, then my taxable income is $120,000. Okay, so I'm paying less tax, and I'm paying less tax. I'm gonna, if I'm single, I'm keeping myself in a lower tax bracket, so I'm not paying extra tax on the amount above, in that new tax bracket, and I'm just, spreading my tax liability out, so I'm not paying a fork load. That's not a thing. Buttload. That's not right either. Boatload? A boatload of tax this year. I'm able to spread it out over the course of a few years. This is something you definitely want to work with a tax advisor or a financial advisor. The financial advisor will be the one that moves your money for you and make sure that you avoid that early withdrawal penalty, rolls it over appropriately. Usually though, guys, a financial advisor isn't going to talk, they're going to tell you, yeah, there's a tax consequence, but it's your tax advisor that's going to tell you like what that tax implication actually is. So it's super important to make sure your team is working together. I love the clients I have who have a financial advisor that I work with because we're able to talk and have those conversations. Because it's important to remember that your financial advisor has different goals for you than your tax advisor. All right, so it's important for them to work together to make sure you're getting the goals you actually want to be reaching. All right. All right, we got about 10 more minutes left. I don't see any new questions, so I'm going to go over last week. We had a few questions. Oh, I do want to, circling back around to the child tax credit, let me find it. I pulled the portal. So this is the link, you guys. If you need to opt out, after we had our, the beginning of this, we had our conversation about the advanced tax credits. If you don't qualify this year, you might want to opt out of getting the rest of these. So here is the link to the portal. So this is the portal that you go into to update, to opt out of these payments, okay? It is not just a go in, set a username and password and be done with it. You have to have last year's tax return or in a tax ID. You have to do a little bit of setup, but definitely worth it if you don't want to end up having to pay that money back come tax time. The other question I had last week, I got asked about the targeted EIDL advances. So there's very few of you, I think, that this applies to, but if it does, you guys, so the advanced EIDL or the targeted EIDL advances it was created, back it up, last year we had the EIDL grants / advances and we had the EIDL loans, right? And we, and the EIDL advance was $1,000 per employee up to $10,000. That that ran out. And then this year, at the beginning of 2021, maybe the end of 2020, they said, okay, we are going to bring back these EIDL advances but we're going to target them to hardest hit businesses, private nonprofits, and companies in the hardest hit areas. And one of the caveats, though, was you cannot reach out to us. We will reach out to you. Okay, we will let you know if you qualify. And this process took a long time. So some people reach out to, then I want to say back in maybe March or April, everybody who had gotten an EIDL advance or grant in 2020 received an email that says, hey, check and see if you qualify. And you went in and looked to see if you qualified. And here we go. So here is the link. If you think you qualified, if you're not sure if you qualified for these EIDL advances, here's the link to, is that the front? Yeah. Here's the one to apply. In here, there is a program overview. There is a map to ensure that you are in this eligible area. All right, so do your due diligence first. Make sure you actually qualify for this. We've had people who are like, oh my God, I'm right on the edge. And, should I apply? And what we're learning is they are hard. Those boundaries of hard hit versus not are pretty strict. They're okay. Let's see, they reached out and then denied because at the point we had more than 10 employees. So it was a TC. Yeah, a lot of different people got reached out, got contacted for different reasons. And then we're told, never mind. So again, go to this link if you think it applies to you, read through it, see if it actually does apply to you guys. And if it does, apply for it. All right. If not, it's there. And the last thing I want to talk about was the ERTC. So, the Employee Retention Tax Credit. This is if you have employees, listen up. If you don't have employees, you can't qualify for this. You have to have employees working for you. All right. And this, there we go. The ERTC credit came out last year. All right, at the same time the PPP came out, our EIDLs. But at the time, they said you can do the ERTC or the PPP. You can't do both. And for most places, the PPP was more beneficial. So we didn't really talk about the ERTC last year. Well, then at the end of December, when they rolled out their next set of relief, they said, actually, you can do both. All right, you can get your PPP funds. You can get the ERTC. You just got to make sure you're not using the same exact pay stubs, pay periods, payroll to qualify for both, or to using the payments to pay for both. Meaning, if I use PPP for January, February, March payroll, right? Then I couldn't get the ERTC for that exact same payroll. Lots of different things. If this applies to you guys, if you're doing PPP or did PPP and ERTC, there's a lot of tax planning opportunity here. I have a colleague, Christy Stone, who specializes in helping with ERTC with people who also got the PPP. If you're a client of mine, I can help you. We haven't really created this service for non-clients to figure out how to help you guys, so haven't done that. But anyway, it's definitely something you want to get some help with, because there is a chance you can get both, and you can probably maximize both with a little bit of help. All right. And so the ERTC was, okay, if you had a certain percent of decrease in 2020 compared to 2019, you can qualify for this ERTC. And then they extended it to 2021. They increased the amounts that you could qualify for and per employee, and they made it so it can last all year. All right. And this ERTC, what happens is it's run through your payroll. All right. So if you wanted to go back and say, yeah, I did qualify for it. I did qualify for it in 2020. I want to get my money back now. You had to file what's called amended 941s or amended payroll reports. to get those credits back. So the question at hand is, how long does it take to get my money, right? How long does it take to get my ERTC money? On amended returns, first it was like 6 to 8 weeks, 2 months, and now we're saying the most recent thing I've seen is 6 weeks to 6 months. And then a few of the posts are like, so give it 9 to be safe. And honestly, you guys, sounds so dumb, but it's so true. I mean, the IRS is just so far behind. I think all the government, agencies are just flooded with work, inundated, and understaffed. It's hard to say when you should get your money, but make sure, just make sure that your amended returns were filed. That's my first suggestion, and honestly, my only suggestion. So if you use a payroll company, touch base with them and be like, hey, I see we prepared an amended 941 for this period. Can you tell me when it was filed? Or submitted to the IRS, and just get some of that just to make sure it's on the IRS's plate and not sitting in your payroll company's plate, because that would be, still nothing on 2020 941Xs. If we were a patient and they were the doctor, we would be dead. And no, joking aside, though, if you were a business and you were relying on this money to stay in business, you might be out of business by the time you get this money. So I think for most of us, hopefully we're getting back on our feet. We're kind of turning our businesses around, and so when we get this ERTC, hopefully it's helping us. Hopefully it's just like bonus money by the time it comes. Hopefully we are all getting back to business as usual, but I know a lot of us aren't. All right. If volume recovered in Q1 2021, but then went back down, are you still precluded from requalifying in future 2021 quarters ERTC? Let me check on that, because so people are like, wait, what? The rules were so convoluted. So you guys, it was like you had to show a 50% decrease in receipts, and then once you got a quarter where you didn't show a decrease, then you qualified for that quarter, but not the next quarter. And what Mark is asking is like, okay, so if we get to a quarter where we don't qualify anymore, but then a quarter later we do, can we? And let me double check. Last I checked, when Jamie and I talked, you could reapply. But let me double check, because I have not talked to her in a while, and you know how these things change. So let me touch base with my mastermind, my COVID tax law mastermind, and get back to you on that. Cool. All right. What do we got? Mark says, can you post the link in the Facebook chat? Which link, Mark? Let me know which link you want. I posted a few of them. I just don't know which. And I think I posted them after you said that. So just let me know if the link you want is there, or if there's a different link you want, let me know and I'll post it. All right, guys. Well, it is 10 o'clock. It is time for me to get on with my day, I guess, and for you guys to get on with yours too. The link for the opt-out trial. Okay, I did post it. Let me see if it posted. It says it posted, but let me actually look. It didn't post. You lying StreamYard. Hold on. Let's see, where's my link? So I am gonna repost the child tax credit update portal. Here we go. I'll just put it directly in here. There you go, Mark. Let me know that you see it. Cool, guys. So that's me. Okay, thanks. Cool. So thanks, guys. I hope you guys have a wonderful Thursday. For now, we're gonna keep doing these weekly. As long as y'all keep showing up weekly, I will keep showing up weekly. If we find that weekly is too much, we'll go to every other week. I don't know. But for now, as long as y'all show up, I will show up. So we will see you guys next Thursday, same time, 9:30 Mountain Standard Time for Q&A and updates. You guys have a fantastic week, a great Labor Day weekend. Excuse me, we'll see you next week. Bye.